Hi, my name's Dave Price, and it's great to have Tony back again. Tony, how you doing, sir?
How are you?
Good to have you, mate. And I know today we wanted to delve into working with investors and how you deal with that and how you structure deals. But I thought before we get into that, it'd be really good because obviously there's going to be some people who've never seen you before at all. So can you just give us a quick bit of background and what you guys are actually doing?
Of course. We've been active in property now for just over 10 years. Pretty much done everything from simple buy to lets to supported housing, HMOs to new build. So pretty much covered every strategy in property by this point. We're focused very much at the minute in terms of sort of supported housing. That's quite a big avenue that we're focusing on at the minute. And I do work for a number of different businesses as a consultant in terms of helping them either grow the businesses and sort of going into property developments and things like that. So, yeah, real mixed bag of stuff at the minute. It's all very busy, but it's all very property focused, and I love it, Dave, to be honest.
Oh, lovely the way you've done the different strategies, and now the supported living is the main focus for you property wise. Then
Yeah, probably it takes up probably 30-40% of my time at the minute.
got ya right. And so we were going to talk about working with investors today, and of course this applies to not just supported living but all aspects of property investing.
Mhm.
So first question is, why do you actually work with private investors?
So over the years, we've worked with a number of private investors for different reasons. I guess there's sort of pros and cons to different ways of funding your developments. Some people have lots of their own cash, and they're in a position where they can fund their own developments. People that don't have their own endless amounts of cash, either because they're just starting out or they're scaling quickly, tend to need external finance, and they tend to use either private investors or they tend to use banks or lenders. We've used a mixture over the years. We've done a number of private investor deals. We've done a number of bank deals, if we want to call them that, sort of lenders. And we've done a couple of deals where it's been a mixture of both. But primarily at the moment, the reason we use private lending on some of our smaller stuff is just because of the cost and the speed. So, last couple of years, COVID, the markets, interest rates changing has made, bank finance and lenders, the sort of challenger banks, quite expensive from where they were sort of 5, 6 years ago when I started doing development. We used to be able to get development finance at sort of 6, 7%. You're now looking at, over 10%. You're looking at 10, 12% for a decent development finance facility. And that comes with it a number of fees, a number of different entry fees, exit fees, legal fees, monitoring fees. And, for some of the smaller deals that we're working on, private finance is just much more suited to that. Obviously, dependent on whether you've got access to it and you know the right people.
Which is the big question there. It's interesting to see that the costs of actually working with the banks have increased massively for you guys over the last couple of years.
Yeah, we've literally been hammered on all fronts in terms of cost. So build costs, labour costs gone through the roof.
Yeah.
Property prices have tended to increase and land, and obviously finance costs have gone up too. So it has been tough market for the last couple of years. Some stuff has started to sort of plateau off. Interest rates are starting to calm down a little bit, but things are definitely still more expensive on a finance point of view than they were a few years ago.
Yeah, and it's an interesting one because when you think about finance, people generally just look at the percentage, what the finance costs. But as you say, dealing with the traditional lenders, there's arrangement fees, valuation fees, and a whole a lot of extra fees on there on top of just the standard interest rates as well.
Of course. I mean, we always try and look at the total cost of finance on a deal. And if you're dealing with bridging as an example, you've got probably a percent in, a percent out,
Mm.
sometimes two and one. So it could be 3% of your borrowing, just in fees. And then you've got your legals on top of that and all the various, if you're on a bigger deal, you might have monitoring fees and things like that. On some of the smaller stuff, you tend not to, but it does add up quite a lot, and it's important to make sure you're factoring all that in.
Got you. Yeah, makes total sense. Look at the total cost of the borrowing rather than just the headline rate. So yeah, I can see why private investors are more attractive. But the big question is, how do you find these investors?
So over the years, we've employed probably different strategies in terms of attracting investment. Social media is very powerful. I'd spend a lot of time on LinkedIn, and I think probably between 60 and 80% of our private investors have come through that platform. And probably the rest has come from networking, sort of face-to-face events or people that I've known from different roles, different careers, who've ended up getting interested in what I'm doing. But a lot of the interest, although it might not generally come from social media, they've been watching what we've been doing, they've been watching progress, they've been seeing the finished projects, they've been interested for a while before sometimes reaching out.
Yep, no, that makes sense. Actually, could you delve into a little bit more depth when you say social media? Exactly sort of how are you using it and what frequency you're putting posts out? What does your social media campaign look like?
We've got a couple of different routes that we use. So for some of our businesses, we use a marketing agency, an outsourced marketing company,
Mm.
who are very good. They're pretty relentless in terms of putting out new content, telling people what we do, different sort of offerings in terms of getting people involved, whether it's selling deals, whether it's helping with developments, that sort of thing. So we do that, but I also do a lot of my own stuff, especially on LinkedIn from a property perspective, which is talking about the market, talking about the projects that we're doing, sharing some of the challenges. Because anyone that's been in property for a while will know that it's not all sunshine and rainbows. And I think people really like that we're open and honest about some of those challenges too.
Absolutely, yeah. Show it warts and all. It's interesting you're actually using a marketing agency to do some of your social media as well. Because I must admit, the idea of keep creating new posts sounds horrible to me personally, but
I do struggle with sort of being able to do it all the time. And I think for certain areas of our business, it's important to have that presence there.
mm,
And they are very good at graphic design and sort of copy and things that I'm not necessarily an expert at. I'd much rather let them guys do that, and I can get out into the market, finding deals, talking to people. That's what I enjoy doing.
yeah, makes total sense. Outsource what you're not good at to people who are actually better than you at it. Makes
Absolutely.
total sense. I think a lot of people feel as though they need to control the marketing themselves, but it's interesting how you've actually worked out what parts you need to control and what parts you're actually happy to outsource.
Yeah, definitely.
Cool. So the investors you deal with, do you have sort of a favorite investor, or is there a profile of the perfect investor from your perspective?
So I guess having done this for quite a while now and sort of successfully agreed several loans or joint ventures and exited them, I have built up what we call an avatar in terms of our ideal investor.
Hmm.
I think a lot of the training courses, a lot of the property educators go, ring your auntie, ring your gran. They've all got cash sat in the bank. They'll be easy to lend to you. They won't need loan agreements and stuff. I don't really sign up to that. I think, our preferred investor these days is someone that is knowledgeable about property, not because we want them involved in the deal, because we want them to understand what the pros and cons are. and what the usual challenges are. I think if you're new to property, you don't understand how many different facets there are, how complicated it can be. We've got some projects that have took 8 months to get through conveyancing just to purchase. And your investors need to understand that that can sometimes happen. That potentially the money they've committed can be tied up for a while. Potentially things can overrun, and I do find that having people that have done their own property stuff or they've invested before with other people are much more realistic in terms of sort of returns. The much more, and we deal with a lot of people that have got experience, that have got successful businesses. They can add value to us. It's not just about the money. For us, it's learning off people that have got their own interests, their own careers, their own businesses that have started and grown to amass some wealth that they want to invest. Those people are great to learn off as well.
Yeah, I can see it being a two-way thing with some investors who've got more experience there. And it's an interesting point you make about how property training companies at the moment are saying, yeah, go and borrow some money from your mum. And I must admit, I coach some of these new guys, and you're like, well, the first property deal you probably do is probably going to be your worst one ever. And you're going to get someone like your mum funding it who really hasn't a clue what they're doing at all. It's, oh, yeah, I can totally understand why you want to deal with people who've got a property background. It makes everything so much easier, doesn't it? So do you actually have sort of favorite investors? I mean,
In terms of the people that we want to build up long-term relationships with people that are going to do multiple deals with us, that we can come to build up a mutual trust. Once you've proven the concept of, we said we were going to buy it for that, we said we were going to do the development for that, we said we were going to sell it for that, and we said that's how long it's going to take. Once you've proven those things and you build up credibility and you build up a track record, our theory is we'd rather work with two or three good, reliable, repeat investors than 10, 15, 20 separate investors that are different on every deal. It makes it much more administratively heavy in terms of keeping everyone updated. Um, Different people work different ways. Different people want to skin deals different ways. It just makes it easier if you've got two or three steady, reliable people to work with. That have a bit of experience. You can pick up the phone to if you've got any challenges. But we also sort of prefer them to sort of leave us to it. We're happy to agree communication and stuff at the beginning, whether they want emails, calls, videos, visits to site. We're open to all that, but we do know what we're doing. We've got established teams. We're not in need of specific advice. It's just more general sometimes. But we don't have specific favourites, but we do have sort of criteria that we want to meet when working with someone.
great. And what sort of criteria is it? What's the important things to consider from your perspective?
So we will talk a little bit about their objectives and what they're doing it for. Some people want to learn about the specific strategies we're working on. So a lot of people are interested in supported housing at the minute. So they want to learn. So they want to know how the providers work, what standards the refurbs need to be, what layout requirements are we looking for when we're sourcing things. So there's some people that come in from an education point of view. There's other people that purely just want a return on the cash. You also see all these posts on social media that are FCA compliant, offering specific returns and things like that. We want our investors to self-certify that they're high net worth, so they're sophisticated investors. We can't breach FCA compliance rules. We take that very seriously for obvious reasons. There's a lot of people posting, "Oh, I've got this deal. I want to fund it. I'm offering X percent." that's just really unprofessional. And the FCA will start clamping down on those people at some point.
Absolutely, yeah. So many people going through unregulated, not with compliance, etc. Yeah, it is a bit of a nightmare. So how does it work with an investor? Can you give us a sort of like a standard sort of case study?
Yeah, so let me try and think of the ones that we've done recently. So we've got a gentleman approached us via LinkedIn, as it happens. He had a SAS pension. He wanted to deploy some of his SAS pension. So a SAS is a small self-administered scheme. I
Right.
hope I got that in the right order. But basically, that's where a pension pot can be deployed. So two third parties as a loan for a set return, or they can invest in property themselves. Tends to be commercially led stuff in a SAS. Um, but he wanted to do that. He was interested in supported housing because he's actually got a family member that he thinks might need something like that in the future. So he was trying to support the sector, which was a really nice thing for him to do.
Mm.
But also he wanted a return on his capital, as people do. They want to build a pension pot. So we agreed terms. We're on a sort of set percentage per annum. We will always do most of our deals for a minimum of a year. So to buy a property, do it up, and then either refinance it or sell it, we tend to find that that 12-month cycle on the smaller stuff tends to work really well. What we always try and aim to do is be realistic with that period of time, but we always aim to pay it off early. So we will try and pay off the majority of our loans before the term, but honour the full interest. That's how we want to work. We want to make sure that we're paying people back the amount we've agreed, because they also want, as well as wanting a return on the capital, they also want to see the capital back. And that's most important for an investor. It's all well and good people promising 20, 30%. But, if they're putting it into a really risky project, um, that investor's probably not going to, see it as likely as someone that's paying something more sensible, that's on a safer project, that's less risky. We need to make money out of it as well. We're not doing it for fun. Some of the stuff that we do does have a social impact too, but it also needs to work commercially.
Right, yeah. Yep. And so a deal like that, as you say, so if you're buying, refurbishing it, and then selling it, how does the structure of that work with the investor?
So what we tend to do, and I'm sort of keep going on about the smaller projects because they're just simple for this.
Mm.
As a typical example, we spend 80K on a property. We then might spend 45, 50 doing it up, converting it to whatever the end use is, making sure that everything's compliant, making sure that the right spec of everything's put in. We get it monitored by building control. We make sure everything's signed off by the HMO officer. And, we make sure we've got all the right bits of paper and compliance in place. And then we factor in, obviously, the return for the investor. So there's finance costs. So we could be all in on something like this for like 130, 140K. We'd agree to put some of our cash in, and then we borrow the rest from the investor. The investor tends to get a first charge on the property, which basically means if anything gets sold or refinanced, they will get their capital back and the interest, and then we'd be left with the proceeds after that. You can do the security in different ways. Second charges if you're using other finance, or even personal guarantees if it's a lesser amount. But we tend to give first charge security on this sort of stuff.
Right. So they'll actually have first charge on the property itself. So they've always got their cash.
So that's the equivalent of them being the bank if you had a mortgage on your own house. Your bank has first charge on the property. And if you go to sell it, they get their money first and you get what's left. So it's the same principle, really.
Right. And I like the fact that you guys still actually put some of your cash in these deals as well. So you've got skin in the game.
We try and do that. Obviously, it's not always possible. It depends on how quick everything else is selling and what other projects we've got committed to. But we'd rather leave a little bit of our cash in each deal. So we're seen as committed. As you said, skin in the game's quite a common theme in property. But we tend to pay for some of the refurb, or we tend to pay for some of the sort of professional fees, however it works. And we've got some investors that want their interest servicing, so we'll pay it on a regular basis, like a monthly payment. And we've got some that are happy to leave it until the end of the deal. So, we can be quite flexible with that. We're willing to work with people. It depends on what their goals are for getting their investment back and what they're actually using the capital for. Some people want to use it for big nice holiday when their interest comes in at the end of the deal. Other people might want it helping with, monthly running costs. They might want to pay for the car out of it. We're not fussed how they use it. We're just here to sort of help and facilitate what they want it for.
Got ya. And so in an example like that, so you buy it, you do the refurb, set it all up. Do you normally then sell it tenanted, or how does the exit strategy work, if indeed selling is a strategy?
So on the supported stuff at the minute, we do sell the majority. We keep some of them. So we tend to put the provider in place, get the lease in place, and we tend to find we can get a little bit of a better return by doing that process. And it helps us to do more projects. If we were trying to keep everything, then we won't be able to do the volume of projects that we're doing because we'd be leaving capital in each deal.
Yeah, no, that makes sense. And so for when you're selling it basically as a turnkey investment, with the service provider all set up.
Yeah. So someone comes along, we agree a price, and they've got a brand new refurbished property. They've got a lease in place with a solid provider. Not all supported housing providers are equal. There's some big PLCs who I won't name on this, that don't look after the properties, that don't do regular checks. There are some smaller providers that, pay really exciting rates, but they're not sustainable. So, we put providers in place that are sustainable, that are thorough, that look after the properties properly. So we are giving a genuine turnkey investment to someone that is solid. The property's been done thoroughly. Been done to a really good standard. Everything's compliant. Everything's safe. And everything else that sort of works with it, the providers and stuff have all gone through further due diligence too.
Got yeah. And do you actually normally find the investor as well? As in you work with one investor during the refurb, and then do you find the investor for the sale after that? If that's the plan, or how does the
Yeah,
sales?
so we've got a number of different contacts for sales. Sometimes people come to us directly because they know what we're doing. Other times it tends to be through contacts of contacts who are actively buying in the space.
Got yeah. So potentially yeah, you get an income from doing the refurb, and then potentially a fee as well on the sales side of it too, which is
Yes. Yeah.
great stuff. Yeah. So as we were saying though, being in property, things don't always go to plan. I'm sure you've had a few a few stories there.
We've got we've got several examples of that just this week with the budget, Dave. You know, one thing that I've found since being in property, especially since being full time in property, is you never know what's going to come next, and you need to be adaptable. So a lot of the time, we have a plan, we have a refurb program, we've got a cost all lined up when we analyze the deal at the start.
Hmm.
Obviously, costs can go up. In my experience, they very rarely go down. We did a poll on LinkedIn the other week about I think it was something like this. Chartered Institute of Building estimated that 70% of construction program budgets overrun. And we did a little,
percent go over time.
yeah, and we did a little poll with some of our contacts, and we tend to find that over 50% were saying that their last project was over on cost. We tend to be a little bit better than that, but that's through going through multiple projects, using the same teams, knowing exactly what your spec is at the beginning, so you're not changing stuff throughout it. But I guess one of the things that more commonly goes wrong at the minute, especially, is programs and delays. Now that could either be your refurb overrunning. So let's say, for instance, you're doing a four-bed HMO and you're estimating between 12 and 16 weeks. Sometimes, depending on resource and labour availability, it can overrun slightly. One of the other things that is causing us a lot of pain at the minute is delays in conveyancing. So we might finish a project well ahead of schedule, something we've done this summer. We finished it ahead of schedule, we finished it on budget, but the solicitors are taking forever and a day to get the transaction through. Now, you can't plan that. One of the reasons that we've got a challenge with it is because land registry haven't registered our initial purchase. So we've come to sell something, but officially on land registry, we don't yet own it because they're so far behind. So, there's lots of things that can possibly go wrong. There's lots of moving parts. And I guess in response to your question, we just try and have an open conversation with an investor at the beginning and say, what does happen if it overruns slightly? We'll put contingency in the agreement. We've got opportunities to extend it, but we try and have that conversation at the beginning just to check that we're both not going to enter an agreement that's going to go pear shaped towards the end if we do hit a few banana skins.
Yeah, it's a difficult one because you say with the experience you guys have got over the years, yet increasing costs of build materials and bills overrunning is something you've actually got quite a lot of, well, you've got some control of, but things like, as you say, the conveyancing, the example of the land registry, it's like you could never have foreseen that one happening at all.
Well, you can try and expedite it, but we've been expediting this particular case for about 4 weeks, and there's four or five different solicitors involved, lots of different bits of paperwork need fixing, and it just takes time. So we just try and factor in contingencies in terms of costs, in terms of program time, and just have open and honest conversations with our investors as we're going through.
I think that's where we go back to, as you say, actually working with people who've got some sort of property experience who actually really understands the challenges
Yes.
like this. And
Massively helps.
yeah, well, than someone completely new to property trying to explain some of these problems.
It just doesn't make sense. People can't understand it.
No, exactly. So,
Neither
um,
can we some days.
yeah, I know the feeling. We've had some similar challenges on my side as well. Um, so, yeah, to drill down into then the investor agreements, it sounds as though everyone is pretty much different depending on the individual investors' tastes, so to speak.
Sure. So, as I mentioned before, some of the investors are only interested in a certain amount of return. So we always factor in what we can and can't go to. So as I said at the beginning, I'm not going to share rates that we agree on here because it's not
No.
actually allowed. But we'll agree a figure that both parties are happy with. We can either service that monthly or we can pay at the end of the agreement. We can agree sort of regular communication. We can agree what happens if it goes over term slightly. Because some people want different things at that point. And we give them security that's agreed. We agree the commercials, and there's some standard stuff in our loan agreement that protects both parties. But we do everything formally. We do everything by the book. Everything's transparent in terms of what's been agreed, and people know where they stand then.
Yep, no, it makes total sense. And you
And it
mentioned,
also protects the investor if their circumstances change and they want to do something different. It wouldn't be the first time that we've entered a deal and then an investor changes their mind too. I feel like a lot of people sort of expect it always to be the borrower that causes an issue in this sort of agreement. But I know many property investors and developers that have had issues with their investors either letting them down or changing their mind, wanting to do different things throughout the sort of agreement. So you need to have contingencies and agreements in place for that too.
Yeah, yeah, no, that makes sense. And so, because you mentioned earlier about pensions and using a SaaS,
Mhm.
again, this is going to be news to some people. Can you just go into a bit more detail about how that works with the pension?
Yeah, and I'll sort of caveat that, Dave, with the fact I'm not a pension expert and I'm not a financial
Not.
advisor. But having normal pension funds, someone deploys it for you, tends to be in the stock market. They pick a range of products that they chuck your pension money into, and they're responsible for getting you a decent return. With the small self-administered pension, the SAS, or you can do things like they're called SIPs. They're very similar. You can decide where that goes. So you can invest it directly into property yourself, or you could invest it with someone like me. So you could loan us some money towards some of our projects. That's called a third party loan. And we can go and do a project and we'll return your cash to your pension with your agreed return.
Right. So it's not the individual taking the money out of their pocket, it's just using their pension pot that's sitting there that they wouldn't be able to access any other way at all.
And they can sort of, utilize that to maybe do something like, the social impact stuff that we do. They might want to do it because they want to be a property developer and that's an access of cash they've got. Um, a lot of people put money into their pensions and have it tied away for ages and actually want to use it. So that allows them to use some of their pension pot whilst they're growing it, if that makes sense.
It does indeed. And is it more difficult? You mentioned something about it's easier on commercial property than residential.
So SaaS is the one that I probably know more about. Um, if you're buying and holding property, you can't hold residential property within a SaaS. It's against the rules, but you can hold commercial property in it.
Right. So you can only flip resident property under the SAS.
Depending on your advisor, some of them are more lenient and more open to you doing creative things within this pension. The HMRC rules, I believe, say you can't hold residential at all. So some advisors actually say, well, that means you shouldn't really be investing in residential. So some allow you to invest in a residential development project as long as you get your money out before it's completely finished. But the majority of the advisors would prefer you to do a third party loan. So they'll loan it to another limited company that's unrelated to their business, their person. So that's how we've done it in this instance.
Right. So they're not actually investing directly in the property, they're investing in your business.
Invest in, yeah, they're lending our limited company money so we can use it to invest in property.
Right. That makes more sense to me now. Yeah, got it. Cool. Um, and again, we touched on this a little bit earlier. FCA regulations. How does this affect what you're doing, and what are the sorts of things you need to be cautious of there?
The strict guidelines from the FCA, Financial Conduct Authority, how you promote investments and how people that are unauthorized, like myself, you can get authorization, but you need to be a big bank. You need compliance departments. You need lots of, legal stuff, protection for your investors, that sort of things. Kind of things an SME won't have.
Hmm.
Um, in order to promote it and advertise it publicly. So again, I'm not an expert on this, but I know pretty much what I shouldn't be doing, and that is investing. Oh, we'll give you 10% as a return, and we'll do it, on this project. So you're only supposed to promote to high net worth individuals and sophisticated investors.
Hmm.
That's because I believe the FCA thinks that they're less likely to take stupid risks and go into projects where people are offering unrealistic returns or they haven't got the capability to deliver the projects that you're investing in. So it's to protect people really, but it's quite worrying the amount of property investors that I see, even the ones that are quite well established, that will just put Facebook posts out saying we'll give you X% on this project. And people putting up some very attractive rates, but are those people going to be able to deliver them at the end?
Very good point. And as you say, a very attractive rate would actually indicate a lot higher risk as well.
Yeah. So, for instance, there was quite a well-known chap in the Northwest that very well connected, went to a lot of the networking meetings, was offering some really juicy, on the face of it, returns. But what it turned out was he was paying other investors back with the next loan he was getting. And they were just sort of recycling the cash. But the reason they were able to pay that was because there was another loan coming to service the interest, and they ended up running off to another country, leaving quite a lot of investors high and dry. But it's fairly clear if you're a property investor, you know what sort of returns people get.
Mm.
People making 40, 50% profits on a property development is very, very rare.
Yeah.
So if people are going around banding those sort of figures around, they're either very, very good at purchasing, very, very good at delivery, or there may be a case where it might just be too good to be true.
Reading between the lines, yeah, I'm thinking that sounds too good to be true with a lot higher risk than anybody would actually imagine.
Absolutely.
Yeah, it's the oldest thing in the world. If it's too good to be true, generally it
Yes. Yeah.
is. But it's very, very easy, especially for newer investors, to get attracted by those high returns and not understand the risks they're taking. Uh, um, so we're the day after the budget. Have you had a chance to
Mhm.
look into that? Has that sunk in yet? Would it be a fair question to ask what your views were on that?
Yeah, so I mean, there's been a lot of publicity, and there's been a lot of hype about what was coming, what was going to happen. Um, Lots of talk of people um, leaving the country, and because it felt like it was going to be that the new government have said it's going to be bad news, it's going to be difficult for everyone. Um, I feel like some elements of it weren't as bad as what people were expecting. I don't know whether that's because they've proactively managed that message and the press have made it sound worse than it was going to be anyway. Um, but when I think of our little world and how it impacts us, we've got quite a few transactions going through at the minute that have got no increased SDLT liabilities for the buyers. Now, that's going to hurt someone. Whether our buyers now decide the deals don't work for them, whether they want to try and renegotiate with some of the vendors, that's going to cause some difficult situations in terms of deals that have been going through for some cases 6, 7 months.
So this is
For
the increase in the second home stamp duty.
yeah, so basically what they've done is stamp duty works on a threshold basis where certain tiers you pay a set amount of stamp duty. The second home has always had an added cost. What they've done is they've made that even bigger. So, as an example, on a 300K property, you used to pay a certain amount of stamp. If it was a second home 300K property, you'd pay a bit more. And that surcharge was another 3%. So, another 9K. What they've done yesterday has made that 9K up to 15 because they put that extra surcharge on to 5%. So on a 300K deal that was going through yesterday, you've all of a sudden overnight got another 6K to find. Now, at that sort of level, you should have enough in it to sort of cope with that. But if you're doing quite a few of these, that's an expensive bill to wake up to overnight, especially when stuff is, taking months and months to go through that's not necessarily someone's fault. So that was quite difficult for us because that was unexpected. And
Mm.
it's also something you can't really mitigate against. We can't go any faster on some of this stuff, as what I explained before. I feel like the capital gains tax was better news than some people were expecting. I know personally quite a few people that are sort of later on in their investment journeys were looking at disposals in terms of trying to mitigate, oh, I'm going to have to pay X amount of tax instead of what it is now. So I'll get rid of my portfolio now. So there's been quite a lot of sales going ahead of the budget. And I believe there's also been quite a lot of business sales too. So it's created a massive activity beforehand. Has it been as bad as people were expecting? Maybe not.
Mm.
But then I look at the wider picture and the things like minimum wage and national insurance. I'm a small business. I don't have millions of staff. I've got one part-time member of staff in one of my businesses. The majority of people we use are freelancers. It's flexible. I can turn it on and off. Um, People with large employment bases, thinking of some of my corporate consultancy clients, minimum wage has gone up by 6, 7%. Now that might be the right thing to do as a nation, as a general thing. I agree that needs to come up a bit, but that's going to put their costs up, not just by 7% on the lower paid people. Everyone else is going to want to see parity. So the
Yep.
supervisors are going to want to go up a bit. The managers are going to want to go up a bit. When you've got a lot of people, that's a big impact. And you've also got national insurance costs going up too. So, the only people that are going to be able to absorb that are people that are passing it on, and they're passing it back to the people that are buying stuff off them, that are using the services. So, although they're saying we're not taxing the working people, everybody's going to end up paying more.
Yeah.
So, and some of these businesses aren't going to be able to afford it. They're going to have to do something different. They might have to automate more stuff. They might have to lay some people off. They might have to shut some unprofitable locations. It's going to have quite a bit of impact, I think, but that's probably a more medium term thing than some of the property stuff.
Yeah. 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 It's interesting, as you say, the just that increase on the stamp duty, 2% doesn't sound an awful lot. 2%, it's only 2% of the deal, isn't it? But if that deal is going to make 10%, just to keep the figures nice and easy for me, it's actually 20% of the margins can potentially be lost. That's the thing to talk about it. 2%, I think, really belittles what it actually is and the impact it can actually have on people's
Yeah,
profits.
I don't see that overnight ruining deals, but it's going to make margins tighter that were already tight.
Yeah.
And that eventually, we're on the side that we're selling some of this stuff at the minute. If we were buying, we're all of a sudden now got that additional cost on our radar. It's like the finance costs we were talking about before. We just factor that in. That's just another cost that we have to deal with. It's like a solicitor's fee. We
Mm.
know that solicitor's going to charge us X for the conveyancing. That's in our budget. We know how much profit we want to make. We know how much our finance costs are going to be. We know how much our stamp duty is going to be, and that's changed, which ultimately means we can offer the vendor less.
Yeah.
And if we're not getting that as a discount off the vendor, and we're then going on to hold it, which a lot of these second homes are, they're investment properties going into the private rented sector. And what does that mean? Your rent's going up because you want to get that return. So, that 300K house, you know, that's cost you an extra 6 grand. So that might be 3 or 4 months rent.
Mm. Yep.
Or you put your rent up by X% to get it back over a certain amount of time. So, I do think the vendors and the renters are going to get hurt by that. I think it's a bad idea to do it immediately. I think it's unfair on the people that have been working to get deals over the line for 6, 7 months.
Mm.
But I think they do it immediately to stop a flurry of activity.
Yeah. Yeah, as you said though, it's just sad that basically all of this points to rents increasing, and there seems to be a big focus on the government trying to
Which has already happened significantly over the last few years anyway, because of COVID, because of lack of supply. They have announced some initiatives on trying to increase the supply. I'll be honest with you, Dave, it's that fresh. I've not had time to look at those properly. There might be some good stuff in that. But again, a lot of the stuff they were saying prior to the budget didn't fill me with a great amount of hope. So hopefully they pulled some rabbits out of the hat there.
Cool. Yes, not as bad as we thought. Is the summary of
Yes.
that one
That's
there?
that's the summary, yeah. Could have been worse. Could have been
Could have
worse.
been worse.
And fingers crossed that, people that have transactions underway do get them through, do get them over the line with minimal pain.
Yeah. Cool. No, that's been really interesting to talk to you, mate. Yeah, and I've learned a few things there regarding the finance side and working with investors. So yeah, really, really useful. Thank you.
So I've really enjoyed it. Speak to you soon.
Cool, mate. All right, I should catch you next time.
See ya.
Cheers.